Hello and welcome back to The Note. Godot is about to arrive. Charlie Brown is about to kick the football. The Federal Reserve is about to raise interest rates, or so it appears, for the first time in almost a decade and after an immense amount of speculation by people like me and by plenty of people in Wall Street. What exactly should we be planning or expecting for the momentous day, and have we all got a little too overexcited about this? With me now to discuss this is the CIO of Bessemer Trust, Rebecca Patterson.
Hi.
Thanks very much for joining me. So, are we overstating the importance of this? Have we got a little overhyped about a rise to 0.5%?
Well, symbolically, it's very important. As you said, it's the first rate hike we've had in almost a decade, and there's probably a good percentage of fixed income traders on Wall Street today who've never actually worked through a rate hike cycle. So from that perspective, it is important. But I think Fed Chairwoman Janet Yellen wants this to be the least exciting Fed meeting of all times. She does not want to disrupt the market, especially at year end with liquidity conditions starting to deteriorate.
Okay, so how is she going to achieve that? Because she really has to go through with raising rates. I think we can both agree that we would have a momentous day on the markets if she didn't. How is she going? What are the key things we should look out for then that will determine how the market responds to this rate rise?
Sure. So the market is almost fully discounting a 25 basis point hike. And I think you and I agree that's probably going to happen.
Yeah.
So then we fast forward to what does Yellen say during the press conference? What does the Federal Reserve indicate to us through the infamous dot plot where they think interest rates will be in the future? My own view is that Yellen will likely try to give us what we'd call a dovish hike. So we get the hike, but then the message from the Fed is that future Fed hikes are going to come only with compelling data behind them and very gradually. I think that's what the market is hoping to see tomorrow, and realization of that outcome would probably be good for equities.
Okay, now that is somewhat of a recipe for continued volatility because we've been data dependent for a while now and we've had elevated volatility for a while now. But you would still basically expect that to be ultimately, we're talking about looking for data for the next year.
Right. And I think we want to stay focused in the U.S. at least on the labor market data. And that's not just the job growth, which suggests that the Fed can raise rates. There's a good economy behind it. But I think really importantly with the labor market data will be the wage data.
Right.
I think over the next 6 to 12 months, we are going to be fixated on wages. And maybe ironically, what's good for Main Street, what's good for the average American, higher wages, could be bad for Wall Street if higher wages leads the Fed to raise rates more than the market's pricing in and start making people nervous about corporate profit margins.
Okay, Main Street might say that it's Wall Street's turn to feel a little bit of the pain.
Maybe.
But, that brings us, I think, to the final critical question I want to ask, which is, as it stands at the moment, inflation expectations are stunningly low. Obviously, for the next year, inflation's going to be low because commodity prices have just come down. Over 10 years, break-evens are suggesting we're barely going to have 1.5% inflation. Is that where you see the most risks at the moment, that we could be taken by surprise by a return of inflationary pressure? Has the US economy actually turned the inflationary corner?
I think we have turned the inflationary corner. I think the US has gone through an inflection point, and that as we look over the next year, some of this is a base effect, simply the year-on-year change. But we are seeing rising wages. We're seeing signs that that'll continue. We're seeing rising housing prices and rents. Frankly, over the last 12 months, the only thing not going up has been energy, gasoline prices, and to a little bit apparel. Although
the
that's
things
not
that the Feds can't actually control.
Exactly. No, we're going to have rising inflation. The question is, how quickly do the markets take it benignly because it happens slowly and alongside better growth, or do they fear that the Fed could be behind the curve and then we see more volatility in equities? I think this is going to be one of the questions for the year ahead.
Okay, Rebecca, thank you very much
Thanks.
indeed. Okay, I hope that sets you up both for what is going to be quite an interesting day and then quite an interesting year. I have to say, I agree on all those key points. First of all, barring an amazing surprise, we will be getting a rate rise. It will almost certainly be accompanied by very dovish pressure, dovish comments. And the great worry for the next year is that almost nobody is positioned for a resumption of inflation. It might be no bad thing for the economy if we got a resumption of inflation, but it's going to create quite a bit of pain on securities markets if it happens.